Mate, you gotta get out of property, mate. The property market, it's going to crash. Haven't you seen the headlines? All those big gurus. I mean, you heard the big American guy? He predicted something big in the US back in the 90s and in the early 2000s. And he's been talking about the property market crashing for ages. I mean, he said it back in 2012. And look, yeah, he got it wrong back then, but he's back now, mate. And it makes so much sense. I've read about him on the internet, and you've got to believe everything he says. You got to sell all your property, stay away from the property market. It's going to crash, and there's going to be some real bargains, right? And people have got all this $1 million property, they're going to be crying, whereas we're going to buy them for half that, mate, for pennies on the dollar.
You can trust bricks and mortar. Property, it never goes down. I don't care what you're seeing in the media. From what I'm seeing in my local area, there are more and more people showing up to the open homes. Auction clearance rates are rising. In fact, I'm raising the sales appraisals on properties as well. So, and if you like this particular property, then look, let me tell you right now, there's at least a couple other people interested, but I reckon if you make an offer today, I'll get it to the vendor straight away, and look, you may be able to get in now. Hi, it's Nero here from Investment Rise, and if you're watching this video, you've probably seen the headlines predicting doom and gloom in the property market, right? It's literally almost a day cut doesn't go by that someone out there is trying to predict what's going to happen to the property market. And the question is, what if you believe them and you don't buy that investment property that you're perhaps looking to buy, and they end up being wrong? You could have missed out on some significant capital gain, right? But on the flip side, what happens if you choose to ignore all the doom and gloom warnings, you go forward and you buy something and then prices do fall? You feel pretty bad then as well, right? So that's why in this video, I want to really analyze both sides of the argument. And first of all, I want to look at why so many people are starting to talk about this property market crashing. In fact, I'd say there are 5 reasons. Number 1, you've seen it in the headlines. Right? As I said, not a day goes past almost that you don't see a new prediction about what's going to happen in the property market. Second reason is that the American property market is falling in Australia. We just follow America, so therefore our market's going to fall as well. Then number 3, and this is probably the biggest argument of all, is that there have been massive job losses. Lots and lots of people have lost their jobs. In fact, it's now in the hundreds of thousands. And with all those people losing their jobs, they'll be unable to pay the mortgage. They'll have to sell their property. There'll be a lot more distressed sales, and hence property prices will fall. Okay. Then number 4, the banks are currently giving mortgage holidays. So they're deferring people's mortgage, or they're saying people don't have to pay their mortgage for up to 6 months, depending on which bank you're with. But once that ends, people won't be able to pay their mortgage and prices are going to plummet. And the 5th reason is that there's going to be a credit crunch. So banks who have been offering all these mortgage holidays they need to recoup that money. So they'll want to then focus on higher quality loans. So buyers won't be able to borrow as much, which means then sellers will have to bring down their prices in order to be able to meet the market. And that's what's going to cause the market to crash. Right? All 5 reasons can seem pretty scary, but they can also seem logical, right? So let's go through each of these reasons and analyze them, starting off with the headlines. In particular, I want to look at the headline predicting a 30% drop in property prices. But if we look further into the article, here's what it says. It says, but the Commonwealth Bank has now emerged from the pack with a grim outlook that's even more alarming. The Commonwealth Bank's chief executive, Matt Comyn, has described the 30% prediction as a worst case scenario. So it's not an actual scenario that they think is going to happen. It's probably not even a likely scenario. In fact, did you know that many of the biggest companies right now have these predictive models where they have worst case scenario, middle of the range scenario, best case scenario, right? And then they release these reports. And the whole thing is they don't believe in their worst case scenario at all, but They know that's what's going to get them profile in the news. And so they literally come up with these worst case scenarios only really to get more media coverage. All right. It's like, for example, someone coming out and saying, in the worst case event that New Zealand could manufacture nuclear bombs and they would bomb the East Coast, then Penrith would become waterfront property. And so in that worst case scenario, you should start buying up Western Sydney and especially Penrith property as much as you can. Now, if someone told you that, you'd probably think that they'd lost their marbles, right? But that's a worst case scenario. Yes, I've exaggerated a bit, but you understand the point. In a worst case scenario, in a hypothetical scenario, then this could be true. But you don't want to work in hypotheticals. You want to look at the actual evidence, all right? So that's what we're going to move on to now. But first of all, let me address this other reason that people are saying the American market is falling, so the Australian market must fall. Well, look, the Australian market has been much more robust than the American market. In fact, when we had the global financial crisis, the subprime mortgage crisis, you might remember those terms, the US market really fell badly. But the Australian market, it remained stable and shortly afterwards kicked off the biggest property boom that we've had on record. All right, so although as much as I guess many Australians think we are like America, our property market is so different for a variety of reasons. So don't just think that just because it's happening in America, it's going to happen here in Australia. Just for example, look at how the Americans have handled the coronavirus situation compared to how well Australia has, okay? The countries are different, so you need to start looking at evidence. So now let's look at the third one. I think this is probably the biggest objection people have about property prices is that they say, look, so many people have lost their jobs. In fact, at the moment, at the last statistics, I think about 50% of Australia's workforce is on some form of government subsidy, whether they're receiving their salary through JobKeeper payment or whether on the Job Seeker payment. Scary numbers. So let's look at, though, if there's ever been a time in history when Australia's had significant unemployment and what that has meant for the property market. Let's look at the following graph, which tracks median house prices, interest rates, and the unemployment rate for the last 40 years, from 1990 all the way until 2020. Now, the source for this data is the Real Estate Institute of Australia, the Reserve Bank of Australia, and the Australian Bureau of Statistics. All right, now, if we look at the thick black line here, we can see that real estate prices have essentially been on a fairly upwards trajectory. There were a couple of periods of a downturn, specifically here in about 2017, 2018, all right? But when we look at how real estate prices are compared to unemployment, that's where something really interesting comes up. Because look at this period here in the early 1990s when we had unemployment above 10%, as you can see by this sort of reddish brownish line. Yet look what the black line did, property prices. They were fairly stable. All right, then now let's go back to the 1980s when interest rates were above 10%, as high as perhaps even 17% in some cases. It was the recession we had to have, which you might remember. And yet, look at what property prices did. Again, they were fairly stable and in fact started to rise. All right, so the conversation about the fact that we have large unemployment in this country, which is true. However, people are then saying because we have unemployment, our property prices are going to fall. Yet there is no evidence of that over the last 40 years. Now, I understand that the coronavirus obviously is a one-off epidemic. We've never had this exact situation ever before, thankfully. Hopefully we never have it again, right? But the fact of the matter is that Australians generally are much more conservative when it comes to property. We hold on to our property a lot longer, all right? Realestate.com.au is reporting very few, if any, distressed sales at the moment, all right? So despite the fact that so many people are losing their jobs, yes, we are not seeing that correlate into property prices falling. Now, some people are saying, oh, that's only because we've got the Job Keeper payment, Job Seeker payment, but that's all going to change and reduce by September, October, and that's when it's going to be Armageddon. But really, again, when you look at the evidence and the fact that the average Australian is ahead on their mortgage payments anyway. Okay, I think you'll find that yes, there will be some isolated cases for sure, but generally speaking, the market will be pretty stable going forwards. So then, if the property market is not going to crash based on the evidence rather than people's opinions, look, I get that there are a lot of people out there who want the property market to crash. They want to get property at a bargain. But unfortunately, just because we want the market to go a certain way doesn't mean that it will. You've got to make your decision based on the data, based on the facts. All right. So if we can understand that the property market isn't going to crash, does that mean then we just go and buy anything? No. This is where research is going to really matter, because there's going to be a flight to quality. All right. So it's going to be your better areas that are going to perform better, rather than taking the entire city, say of Sydney or Melbourne, and thinking, oh look, if this particular suburb performed well, then that one will as well. Not necessarily. Individual suburbs are going to perform differently. All right. So for example, if we look at Victoria right now and what's happening in their rental market, you can see here in this article from the Herald Sun on the 20th of May, there are 10,000 tenants in Victoria who've been approved for rent reductions. And that's as a result of the state government's $500 million coronavirus rental relief package. In fact, rents were granted an average discount of 31% from those initial or registered agreements. That's according to the Tenants Victoria Chief Executive, Jennifer Beveridge. Now remember, the average rental return in Melbourne has already been the worst across all capital cities in Australia. And now, with rents being reduced so much, if you're someone as an investor who wants to buy in Melbourne, you've really got to work out, yes, the Melbourne market will obviously come right and the prices will rise in the future, but can you afford the cash shortfall as an investor? Because you have, I would say, virtually zero hope of finding a property in Melbourne where the rental returns currently are going to come anywhere near covering the mortgage. So you need to be certain that you have enough surplus funds to be able to cover that shortfall. Plus, you need to ask yourself, if you buy that kind of property that's got a high negative cash flow, or high negative cash outflow rather, will you then be able to afford additional properties if your goal is to build a property portfolio? Okay, so there are going to be certain markets that you want to stay away from, and I believe most of Melbourne will fit that criteria. There are some suburbs, yes, that I like, but most of Melbourne right now I'd stay away from. Similarly, like the Gold Coast unit market is another market I'd want to stay well away from. All right, so if you want to look at what kind of suburbs to look at, the first thing I'd be saying is look at the supply versus demand. Is there greater demand than supply? If so, then that's a really good indication prices are going to hold their value and will start to rise. Demand versus supply is the first thing. The second thing is you want to look at the vacancy factor. Okay, you cannot invest or have the same mindset when it comes to buying an investment property like you might have done even 6 months ago, which is find an area that you like or find an area that's close to the infrastructure and just buy whatever you can afford. Right, there are so many areas right now close to infrastructure where the vacancy rate is at all-time highs and still increasing. So you've got to make sure that you're doing that level of research and you're buying in areas where the rental vacancy is really, really tight. It's below 3%, so that you're buying in an area that's undersupplied, which means there are more tenants looking for properties than actual properties available to rent. And then number 3, look for what's going to make your property stand out from many of the others in that particular suburb. Like, one of my favorite strategies to use is to look for properties that are close to good schools in the area. In fact, realestate.com.au right now is showing that properties close to good schools are actually achieving a premium price, and I believe that will always continue. Plus, the other reason why I really like to find properties close to good schools is because if you can get a tenant who's got their kids going to that local school, you're essentially going to have no vacancy for quite a number of years because they won't want to move out. All right. So certainly I think that right now there are going to be winners and losers as a result of this post-COVID-19 environment. The winners will be the ones who do their research and don't follow the headlines and look for good quality property, buy and hold them for the longer term while getting good rents. The losers, unfortunately, will be people, many of them, who choose to wait out the market, believe the headlines, and then in 12 months' time look back and go, God, I wish I'd bought. Or they'll be the ones who buy an off-the-plan unit or a unit close to where they live in the city that they like without doing their research, without checking the vacancy factor, without looking at the rental returns, and then as a result regret buying that particular property. The only question for you is, which side of the fence are you going to sit on? Hey, thanks so much for watching. If you found this video valuable, can I ask you to do me one favor? Can you please share this video? I think at the moment when there's so much, fake news or sensationalism in the media, it's really important that we get this information out there so that people can make investment decisions based on facts and data. Either way, thanks for watching.